Hi, I'm Laura Suter, Director of Personal Finance at AJ Bell, and today I'm joined by Ryan Hughes, who is Investments Director at AJ Bell. We are going to be looking back at 2023 and how markets performed, but also the impact that had on the AJ Bell funds and the Managed Portfolio Service range. We're also going to look ahead to 2024, look at our outlook for markets there and the impact that that may have on the funds. So Ryan, first up, let's look back to last year. How did the markets perform in 2023?
We can probably split 2023 into a year of two halves. If we think about the equity market, broadly the equity markets have ended the year well and quite strongly, having had probably a mixed period early on. And we can separate the equity market even further by thinking about the different regions. The US has had a very, very strong year, and so that means on the whole that global equities have performed quite strongly. However, if we look at Asia and emerging markets, it's been much, much more challenging, really held back by weaker performance in China. UK equities have been somewhere in the middle. They've done okay, but really haven't set the world on fire this year. Bond market has definitely been a year of two halves. We've seen real challenges early on in 2023 when we had a sharply rising interest rates, when we had inflation that looked like it might get out of control. But actually, as we went through the summer and into the autumn, things started to look a little bit better. Central banks looked like they were pausing the rate rises, inflation data started to come down quite sharply, and therefore the bond market got quite excited that this could mean we're at the end of the rate rising cycle. And that's seen bond prices recover actually pretty strongly as we've gone right into the end of 2023 and has set, I think, quite a nice tone as we look forward into 2024.
So if we think about the changes that you made to the funds, last year you increased exposure to cash and fixed income while reducing equities. What impact did this have on performance?
In honest reflection, I think they had a mixed impact on the portfolio. So reducing equities, we moved into high yield bonds and into some cash, and in an absolute basis, I think that's actually worked out reasonably well. But actually, when we go now right to the end of 2023, equities have actually broadly had a good year. But high yield bonds performed well, and we got some decent returns from cash. So I think on a risk adjusted basis, and obviously we're managing these portfolios, thinking about the different risk profiles as well as trying to deliver the best possible absolute returns. I think those moves worked out fine, but clearly, on reflection, we should have had a lot more US equities there, and then things would have looked quite a bit better. But the US equity market was very nuanced last year. 7 stocks performing incredibly well, and pretty much the other 493 in the S&P 500 not doing very much at all. So yeah, I think if we marked our card for 2023, I'd say it was an okay outcome from an asset allocation perspective. But we hope that some of those changes that we made last year and go into 2024 actually have quite a positive effect on the portfolios.
So can you just talk investors through how you get to that strategic asset allocation?
Sure. There's various inputs that go into the modelling that we do. And if we take a step back, these portfolios, the asset allocation is derived by using mean variance optimization. So what do I mean by that? Where we're trying to get the best possible return for the set level of risk for each portfolio, whether that's a cautious portfolio, obviously having lower levels of risk, right through to an adventurous or global growth portfolio having a higher level of risk. And to go into that, we have 3 variables. We have our expected return for each asset class, we have our correlation between each asset class, and we have our volatility for each asset class. And when we put those into the optimization process, which effectively is the computer simulation telling us what the best outcome will be, what the best portfolio, most efficient portfolio can be, then that's what points us in the direction of having our long-term strategic asset allocation.
So if we look ahead to the rest of 2024, do you think that interest rates have peaked? And if so, what impact has that had on your portfolio allocation?
It certainly does look like central banks have reached the end of the interest rate rising cycle. If we look at the economic data that is coming out now, we're certainly seeing quite a sharp slowdown in inflation. We're seeing wage growth be much, much lower. certainly across many developed economies, and we're seeing, again, slowdown in various bits of Asia and emerging markets. If we think about data that the IMF puts out, looking at global growth, then whether it's developed markets or emerging markets, they are looking at lower global growth, lower GDP growth for 2024 than we've seen in 2023. Now, that's not by a huge amount. We are talking relatively small margins, but it certainly does vary to quite some degree across markets. So I think if we've got lower and slower global growth, we've got falling inflation and wage growth, and effectively we can just call that a slowing global economy, then we should see interest rates, certainly shouldn't see interest rate rises on the back of that, and maybe when we get into the back half of 2024 we start seeing interest rate cuts come through. Now that means we do want to position the portfolio a little bit differently there, and therefore I think adding some duration to the portfolio in the fixed interest element is a sensible move to try and capture some of that value that will then exist in the bond market.
You mentioned earlier that one of the big themes of 2023 was, US equity markets being very strong, and particularly the Magnificent Seven. How has that impacted on the portfolios and your allocations?
I mean, it does depend on which part of the AJ Bell product range you are in. If you're an investor in the AJ Bell funds or the passive MPS, you've got passive and you've had passive exposure to the US market, so the S&P 500. So you've had a full allocation effectively to the 7 large technology stocks, which have really had quite a phenomenal 2023. If you're in the active MPS or the pactive MPS, then you don't have as much exposure. Effectively, it's very difficult for active managers to be overweight these stocks because they now represent such a large part of the US benchmark. So that you are underweight in those particular portfolios. Now, obviously that's been a little bit of a headwind for 2023, but I think it's interesting if we start thinking about 2024 and where that goes from here. So those stocks are on quite expensive valuations, expensive multiples, and when we talk to the active managers that we use in the US, they're starting to see some quite interesting opportunities away from those large dominating stocks. Now, of course, we don't know how that will pan out, and it may well be an excellent move to be underweight those. It may well prove to be a headwind again, like it was in 2023. But there is a range of options for advisors to invest in, and maybe then it gives them the opportunity to reflect their own view. If you want market exposure and market beta, the passive range and the AJ Bell funds sit there. But if you want another type of exposure and happy to be underweight those stocks, then the active MPS and the pactive MPS will certainly have that positioning given their natural exposure to active managers.
So when we think about all these things that we've discussed and your outlook for the rest of 2024, how has this impacted your long-term expected returns for the different portfolios?
Probably the best way to think about this is from the perspective of the efficient frontier. What we're trying to do with our mean variance optimization, our long-term asset allocation, is get the most efficient portfolio for the level of risk that we are taking for each portfolio in the range. And what we're seeing is there's actually been a flattening out of the efficient frontier. And if we think about that at the lower risk end, so if you're a cautious investor, a moderately cautious investor, then actually your expected future return has just increased slightly. And that's all to do with the fact that we can now get higher returns on cash than a year ago, and also the yields on fixed interest are higher, and obviously those portfolios are more tilted towards those types of assets. If we think about the higher risk end, so if you're moderately adventurous, or in the global growth strategy, then actually those expected returns have just fallen back a little bit. Now that comes back to what we were talking about earlier with global growth and GDP slowing slightly, and therefore expected returns on equities just falling back a little bit from where they were a year ago. So overall, I think the returns still look appealing, they still look attractive, but the shape has just shifted a little bit from last year, given how the market dynamic has changed as well.
Thanks a lot for your time today, and we look forward to catching up with you and the rest of your team throughout 2024 to hear about progress on the AJ Bell funds and the managed portfolio service range.